To the program, let's head over to Ethiopia. The government over there has started the process of restructuring an additional $1 billion of public debt as it seeks to free up more funds to support its economic recovery amidst this global COVID-19 pandemic. The restructuring plan, however, does not cover Eurobonds. The Finance Ministry says the restructuring will provide a grace period of roughly 6 years and extend the maturity by 10 years. At the moment, roughly $2.5 billion in principal and interest payments have been postponed for 5 years by commercial creditors under the first external debt restructuring scheme. This announcement comes after Ethiopia requested to rework its debt under the G20 common framework. All right, then let's explore this in a bit more detail with Zemedeneh Negatu, who joins us now from the Ethiopian capital of Addis Ababa. Zemedeneh, good to see you on the program. So, Ethiopia's made this request, though, to the G20 and to the Paris Club to restructure its debt as far back as February, but we still don't have a creditor committee set up yet. The IMF, in fact, was speaking about that this week. Why has that happened?
Well, Rob, it's good to be back on your program again. Thank you. As you indicated, Ethiopia has been working on debt restructuring, partly with the DSSI program, but also reprofiling with the IMF, and it's been ongoing for the last couple, 3-4 months. It sounds like they're making progress, but as you indicated, the IMF is also putting in its effort to expedite the process. But for me, the key point is that they've actually made very significant progress since they started this process. As you indicated in your intro, they started with a target of $4 billion, of which $2.5 billion has already been restructured, extended, the repayment period has been extended, and the interest rates also have been renegotiated. So yes, this process started, as you said, in February, but for me, the result of what they've already achieved is actually a very good indicator that they're on track. Perhaps with the establishment of this creditors committee, it probably could be accelerated as well. But also in your intro, you indicated that they're now focusing on the next $1 billion. Of course, it doesn't include the Eurobond, but to me, very frankly speaking, the Eurobond I don't think is a very significant component. It's only $1 billion. And the coupon rate, if you just clip it and pay it this year, is around $66 million. So it's not a very significant amount. But anyways, to re-emphasize what the Finance Ministry said, at the moment, that is not on the table. They're just looking at bilateral, multilaterals, and the billion is in addition to the $2.5 billion that they've already restructured. This is based on the public information that they've already disseminated this week.
Right. So just to be clear, to give us a sense of context that we have here, what Ethiopia is trying to deal with is mostly a short-term liquidity issue, as opposed to, the economy is messed up, we really can't pay any of our debts. It's a liquidity squeeze that needs to be attended to, right?
Exactly. I mean, the economy actually has done fairly well. I mean, despite COVID, and as you know, Africa as a whole last year had a negative GDP growth, Ethiopia was one of the very few countries who actually grew, according to the government, last year 6.1%. In the fiscal year that just closed this week, the forecast is 8.5%. So you're absolutely right. It's just to address the short-term liquidity, because the fundamentals, the long-term fundamentals of the Ethiopian economy are still attractive. There are some macro challenges which they're trying to address, like, for example, inflation. But overall, I mean, I'll give you an example. Exports, again, despite COVID, despite the whole world being shut down last year, exports for the first time in several years increased by 19%. It's a record $3.5 billion. Yes, granted, on $107 billion GDP, it could do better. But remember, in context, it's a record export. So the answer to your question is they're trying to address the liquidity, but the long-term fundamentals are still attractive.
Okay, so Ethiopia did get DSSI relief from at least 5 members, I believe, of the Paris Club.
Right.
But where does that leave debt due to China? Has any of that been restructured? Is there work going on around that?
Well, it's interesting. I mean, at least from what we've heard from people in Washington and other places, actually China has signed up to be part of the DSSI. I'm not quite sure if it's actually gone all the way to finalize the process. I know the U.S. government has put out a statement, I think this week, saying they would like the Chinese to expedite their engagement in this process. But it sounds like at least they're on board. Initially, there was some reluctance, I think, by the Chinese. They wanted their debt, not just in Ethiopia, by the way, throughout Africa, and all the debt that they provided across Africa, they wanted it to be treated as bilateral and not part of the Paris Club, not part of the DSSI. But the good news is they've joined it. It's just that, as I said, there are some indications that others are pressuring or indicating to the Chinese to expedite the process. And that's apparently where this process is at.
Okay, so looking at the currency side of it, I mean, looking at the graph of the Ethiopian birr, at least that we see it on the interbank market, over the last 5 years, the birr has gone down by nearly 100%. It's 13.5% weaker to the dollar in the interbank market. So far in 2021, reserves are falling as well. What's the currency reform plan that we're looking at?
Right, again, a very good question. Actually, the government has signed up with the IMF to have a flexible market-determined exchange rate. In the past, if you look at the last 15 years or so, it was a very rigid, not always realistic reflection. It was depreciating by 5, maybe 6% per year, when the actual real rate was higher than that, as measured by the parallel market. So as part of the move in the next because there's a lot of reforms in the financial service sector. So as part of the reforms, what the government has decided, I think in partnership with the IMF, is to move towards a market-driven exchange rate. And that's why what this is now reflecting is the market ultimately will say what the exchange rate will be, and the government has accepted to that approach, as opposed to what it used to be in the past, which was not realistic. So that's part of the reason. But as I said, as I indicated earlier, though, you talked about the reserves, but if Ethiopia continues to increase its forex generation, primarily from export, then I think the reserve will hopefully continue to increase. But remember the context we're talking now. Last year was the worst year for the global economy, including Africa, in a century or more. So despite all that, frankly speaking, to increase export by 3.5%, by 18% to 3.5 billion, and curtailing as much as possible imports and expanding local production. It's not there yet, but they're working on that. When you take all these factors together, I think the reserve hopefully will continue to increase, but you need to take the global context of what the whole world was operating in. And in that context, I would say they've done fairly well.
Okay, one last question for you. This is slightly unfair because I know you don't work for Ethiopian Airlines, but some of these debts that Ethiopia has, some of them are linked, of course, to state-owned entities. And last May, Ethiopian Airlines said, look, we're fine, we'll manage, we're not going to we'll keep servicing our debts, and we're not going to be seeking state support. Is that still the case?
Absolutely. In fact, I'm glad you asked me this question, because just to give you context, if I'm not mistaken, Ethiopian Airlines was the only airline in the world to have made profit last year. And it was, if not the only one of the very few airlines in the world that did not get a bailout. It continued to service its debt last year, even at the depth of the pandemic, and is actually now back on strong financial footing. So they continue to, their credit rating is still as good as it was pre-COVID. And from everything I've heard, they are continuing to service the debt on time. They did not need a bailout. They're using their own cash flow. So in that regard, I think it's a shining example for Africa, actually, that it's some of these multinationals like Ethiopia have weathered the turmoil, the COVID turmoil that occurred last year.
And that cost control that we always talk about with Ethiopian Airlines, that's really coming into play at this point, isn't it?
Exactly. And the rejigging of their fleet from an all passage to add a lot more cargo capacity when there was no passenger last year anywhere in the world, that also helped them. So they were very nimble, even though they're a very large airline of 130 aircrafts for $4.2 billion in revenue, 17,000 employees. The cost cutting, as well as the repositioning of their fleet and their strategy on how to survive, actually should be a lesson, probably something to be taught in the Harvard Business School or some other these top business schools, how African companies actually manage to wither. Not many, but there are shining examples like Ethiopian Airlines.
Indeed. We'll leave it there for the time being. Zemedeneh Negatu, thank you very much. Always fun having you on the program.